Afternoon. So glad you are here. We're going to get started. I think we'll have a couple others join us along the way. And we are going to get rolling. You're going to get a lot of information today. We actually, as we've talked to people after doing this a couple of times, have heard that we're probably going to split in the future, talk about financial planning and generosity separately. So if you're here, you're getting sort of a two for the very cheap free price of one. But hope that you'll gain something out of this as we're going through things today. If you have questions while we're going through things, by all means, feel free to just send in a text on the group chat there. If you'll just send it to me, by the end, we will make sure that we get a chance to answer your question. And so having sort of laid all that out there, we will we'll get rolling here and look at some things. So this next slide you're going to see has a picture of a truck, and you may be wondering why I'm showing you a picture of a truck when asking you if you have a plan. This truck is a 2000 Chevy Z71, and it is exactly the truck that I had in 2000, except mine was black. I am a Texas boy through and through, and so that was sort of my dream truck at the time. And I was working in wealth management. I had a client that I obtained who was a NASA engineer, brilliant guy. And he was making deep six figures, but they were living on only about $65,000 a year. And when they became clients, they had over $11 million in their 401k, and about half of that was sitting just in cash outside of their 401k. And as a young advisor, I was excited about it and got them invested. And about 4.5, 5 months later, I get a call from his wife. Her name was Mary. Their names were William and Mary, like the college. And Mary said, "Would you talk to William?" And I said, "Sure. But before I do, what am I talking to William about?" Because as a young guy in the industry, I was afraid that I had done something wrong or messed up. And I said, what can I talk to William about? And she said, "Well, would you talk to him and tell him that it's okay for him to go and to buy a new car?" I said, "Well, what do you mean?" She goes, "Well, the 15-year-old Chrysler New Yorker he's been driving for the last 15 years, the transmission went out. And he wants to just take it to the shop, but he's always dreamed of having a truck." And I told him that he should just go buy the truck he wants, but he's afraid if he does, that we won't have money for retirement. They were already in their 60s. Now, at the time, had they earned absolutely nothing on the funds that they had enough money to live for about 159 years based on their current spending level. But he was worried about having enough money for retirement. So I got him on the phone and I said, "Hey, William, look, you're good. You're more than good. Absolutely go buy the truck." A few weeks went by and they were in the office for a review of their portfolio and their account stuff. And while they were there, when we concluded, the wife said to me, "Hey, we went 2 days ago and bought the truck. Do you want to see it?" Now, what you see here is the truck I was driving. I absolutely wanted to see what kind of truck a millionaire had bought for himself. So we walked out to the parking garage, and when we got to the parking garage, there it was in all of its glory and splendor, a Ford, single cab, Ranger pickup truck with cloth seats. That's right. They had not stepped out any high. They had bought sort of the baseline Ford Ranger because they were afraid of what it might do. And in that moment, I realized the importance of doing true financial planning. Because here was someone who had something at their disposal that could have been a huge blessing to them. And instead, they were so stressed about it that they weren't really catching on and weren't really living into the blessing that was there for them. So the question really becomes, do you have a plan? A recent study showed us that only about 25% of all Americans have any form of a written financial plan. And it's in single digits that have a professional, comprehensive, done by an expert financial plan. A Schwab study that sort of followed up on that found out that 70% of people in America today live paycheck to paycheck. And the American Psychology Association chimed in to let us know that people who have a plan deal with far less anxiety, far less stress, far less of these things that can sometimes confound us. Benjamin Franklin is known to have said, if you fail to plan, you are planning to fail. And yet in this crucial area of finance, we find out that that's exactly what happens a lot of time. People don't truly have a plan at all. So why do we plan? I like to look at scripture here, and there's a verse in Luke chapter 12 that I think comes to mind. It says, for which of you, desiring to build a tower, does not first sit down and count the cost, whether he has enough to complete it? And that verse just really sort of says, if you have a goal and you have something you're desiring to do, you certainly need to have a plan. And so one of the reasons that we want to make sure that you have a plan is because too often it's easy to think because I have a goal that that goal is my plan. A goal does not equal a plan. A goal is what you need a plan for. And you'll see here in a few minutes that on the other side of having that plan, then you need a disciplined strategy to execute that plan well. See here on the picture, the show Shark Tank. If you're familiar with that show, it's where people come on and present to try and get these billionaires to invest in their businesses. And it's interesting, if you ever get a chance to watch it, if you've never seen it, to go check it out, because what you'll find are the people whose businesses take off and succeed, the people who get investments from these people, are the people who come in and have a plan. They're the people who, when they're asked questions, and they are asked some tough questions, are able to answer them, not on the spot, but based on the plan they already have in place. And the people who just get destroyed, sometimes humorously, are those who've come in and they have a great goal. They may even have a great idea. They may even have a great product, but they don't have a plan for their business. It's very important that you have a plan. So what does a good plan really look like? Well, on the left-hand side there, you sort of see what happens when you don't have a plan. Your finances can become restricting or overbearing. Financial situations can produce anxiety. We've certainly seen that recently in the COVID situation. Decisions a lot of times are fear-based. If I buy X, will I have enough money to pay my bills? If I pay my bills, will I have enough money to go on vacation? And so fear sort of drives the way decisions are made. And even when you do buy those extra things, it's all about sacrificing. Some people even think that having a good plan means that they have a budget, but having a budget is just a small portion of it. It tends to create an environment where when markets downturn, like we just saw, people panic, and they're constantly asking the question, what if this happened? What if that happened? Where would it leave me? But having a good financial plan begins to allow you a chance to have peace in your world, to have confidence in your world. It allows you to make goal-based decisions. So when you're trying to choose between different options, you can make those decisions based on your goals, not based on your emotions in the moment, not based on the market in the moment. It successfully lays out a way to get you from where you are today to where you want to be at some point. The other thing that's important about a comprehensive financial plan is that it addresses all aspects of your financial picture. It takes into every detail. When I started in this industry, as is honestly typical of a lot of the larger financial planning companies, I thought a financial plan meant knowing your goals, determining your risk tolerance, and investing your money accordingly based on how much time you had between then and your goals. That is such a small fraction of things. A truly comprehensive financial plan looks at everything. It looks at your 401ks that are existing in the companies you're at right now, not just the things that are under management. It looks at your savings. It looks at your liabilities. It looks at real estate that you own. It looks at ownership interest you might have in a company. It looks at royalties that your family may have. It looks even down the road to money that you might inherit. It takes in the full picture of where you're financially at and where you're financially going to be. And then it allows you to make informed decisions. I was talking with someone just a few weeks ago who had recently purchased a home in the North Houston area on the lake. It was their second home, and they had a mortgage on it, but they had several $100,000 sitting in cash. And the question they wanted to know was, am I better off putting this money in the market, or am I better off paying the mortgage and just paying off the second home? Well, before they could become a client, the person they were working with took the $300,000 that they had in cash and dropped it in the market. That was the last week in February when that happened. If you've been following the market at all, you know what's happened since then. And it just probably wasn't the best decision. There were indicators at the time, but it was an emotional decision or a greed-based decision rather than driven by a plan. A plan allows you to weather the storm when markets are crazy, and overall it allows you to achieve more. The average investor without a plan, without working with an advisor, has about a 1.9% rate of return over time. That's actually lower than the inflation rate. But having a plan and working with an advisor puts you somewhere close to 6%. And so it's because it allows you to have something to be disciplined to. It also gives you something to measure to. When the market tanks like we saw it do in March, it's hard not to look at your January statement or your February statement and then turn on the news and see where the market is and freak out. Or to look at your January statement and your February statement, and then you get your March or April statement and you just go, wow, I lost all this money. But that's because you're comparing against where you've been, or you're comparing against the market rather than comparing against what do you need to be doing today to reach your goals. If even with the market downturn, you're still on track to reach your goals, there's a sense of peace that can come from that helps you to invest confidently, but also just to sleep better at night. George Patton, the great general of World War II, said, a good plan today is better than a perfect plan tomorrow. I think sometimes we want to kick the can down the road until we can get the perfect plan. You may never have the perfect plan, but you can have the best possible plan that you can have today in place. So as I mentioned earlier, a good plan doesn't just look at risk tolerance or time horizon or asset allocation. You see there on the right all these other things that it looks at, so that it's really getting a comprehensive view of what's going on in your finances and allowing you to position yourself in the best possible way. The other part that matters with having a plan is that you have a good team around you that is helping you to fulfill that plan. Just as if you were playing sports and you have a good game strategy, if the team isn't on board and the team isn't working together, then you're only as good as the parts that are making the plan implement. Typically, we like to think about having a team when it comes to handling the areas of our life that involve finances. And it generally involves sort of your financial advisor, your wealth manager, your CPA, and your lawyer. Now, you'll see here in a little bit when we bring Ryan Asunto in to talk to us about generosity, that sometimes yours isn't a triangle of people, it's a square or maybe even an octagon. You can have different pieces, but hopefully you want all these people moving around and operating in your best interest. And that's great, except they all operate differently if they don't have a similar document to operate from. A lawyer tends to bill by the hour. And though they're great people, I'm not knocking them, we all need them, but they're incentivized to offer you legal advice about when you pass in their state that involves them being able to bill by the hour. A CPA generally handles your taxes not before taxable events in your life, but after taxable events in your life. Right before we started this call, I was on the phone with someone looking to sell their business. In fact, they were supposed to have sold their business last month, but because of COVID, there's been a moratorium put in place and the sell documents have been pushed off for 90 days to be sold. And in that conversation, what came out was they haven't talked to anyone about the tax implications of the sale of their business. They're planning to do that afterwards. And yet you'll see here in a little bit how radically that can shift not only what you end up paying in taxes, but what you end up being able to give philanthropically, and even what you're allowed to walk away with for your lifestyle at the end. So while you're going to have a team, a financial plan is really what sits in the middle and brings your team together. Now, for obvious reasons, we're a little bit biased, but we believe that your financial advisor, your wealth manager, is the best person to walk through with you, putting your plan together, and that your lawyers and your CPAs and these other people then become vital pieces of helping to fulfill that plan. But we want you to have a plan so that everyone is on the same page and able to work together in moving forward. So the plan the team matters, but the plan, it actually matters even more. There's this concept called the identity of indiscernibles, and it's found in sociology and psychology and philosophy. And it's basically typically understood to mean that no two objects are exactly the same or have the exact same properties. So too, no two financial plans are exactly the same or have the exact same properties. So if you're working with someone and it's a turnkey product and they're just giving all their clients the same advice, they're probably not helping you with your plan that fits your needs. One of the most irritating questions you'll find that we get asked all the time, especially in down markets, it seems like, is, hey, do you have a good stock you'd recommend I buy right now? And our answer is constantly, there's a lot of good investment opportunities, but I need to know more. I need to know why you're wanting to buy it. What's your goal? What's your interest? There's so much that goes into making a good investment choice. What's good for one person may not be good for another person, and vice versa. So there are several benefits for you to having a good plan in place. One of them is it becomes a guide for your decision making. I mentioned earlier, set a goal, have a plan. Then after you have a plan, you have a discipline to reach that plan. That's sort of that guide for decision making. It allows for regular reevaluation and adjustments. If your goals change, you can shift things. If you happen to somehow come into a large sum of money, we can reevaluate and adjust things. And we would recommend to people that at least once a year, if not twice a year, you should be sitting down with a professional to evaluate your comprehensive financial plan. It creates a clear investment discipline, not just for you to follow, but also for the people that you're working with to follow, those lawyers, those CPAs, and that wealth manager, so that they know what's your risk tolerance, what's your horizon, what are all these other moving parts. It reduces stress by giving you a proper metric, not the market. It outlines the personal steps you need to take. You need to be saving $100 a month, $200 a month. You need to be maximizing your 401k where you are. Is your 401k, it's rare, but is it such a bad plan that you shouldn't be using it at all? It gives you a comprehensive view of all your finances. A huge one is it puts the family on the same page. It allows you to begin to have conversations with your spouse or significant other, but also with your kids. Our mission at Archetype is to help families thrive across generations by matching their wealth with their purpose. And one of the ways that we do that is, in that family thriving part, is to give you tools so that you can safely and securely and confidently talk about your finances. So it improves the communication there as well. You look in the bottom picture there, it's just basically a blueprint of a home, and it looks really confusing to me. It looks confusing probably to most people who look at it, unless you're an architect or you're in construction. But it's something that we would expect in building a home. Well, the same is true in building out your finances and your financial goals. It is a lot of moving parts that might be complicated, but you certainly want someone who's serving as the architecture and the building team in order to get you to where you want to be. So really the process that we would say is you set your goals, you define your plan, and then you establish your discipline. And that discipline, as Jim Rohn said, is the bridge between your goals and your accomplishments. It begins to tell you what needs to happen. And as long as you're sticking to your real sense of doing what's necessary for the plan, then you don't have to worry. I think sometimes we mistake activity for being disciplined, but discipline is a controlled activity, a planned activity to move you from point A to point B. My son is getting ready for high school, and he's a pretty gifted athlete. And he is taking advantage of COVID to train 2 or 3 hours a day. He's working out, he's running, he's lifting, he's doing all kinds of things. But before we let him start into that, we sat down and we did a comprehensive plan to get him from where he is today to where he wants to be by the time football camp starts. And all the activity that he's doing sticks to that plan. And it's his discipline to do those things. It's allowed him in just about 6 weeks to add about 12 pounds of muscle mass. Now, he could take that 2 or 3 hours and he could do a lot of different activities, but not have the gains toward his goal that he wants to have if there's not a plan and discipline on that plan. And when you do operate a plan, instead of being judged by just emotions and driven by emotions, then you find over time that performance pays off. In the last couple of weeks, I've asked a number of people at different times, say, how much do you think the market's down this year? And the general answer I get is somewhere north of 20%. And yet the truth is, as of last week, the market was only down about 12% for the year. In fact, we just finished or are finishing up the month of April, and it appears that April is going to be one of the best months in the market since the 80s. It's actually up substantially. Markets fluctuate. A plan keeps you from reacting emotionally. And what you see here, and I'll actually bring your attention sort of to the bottom part there, is that over a 15-year time period, with ups and downs, and the 2008 crisis is included in these numbers, as well as the current crisis, that the Russell 3000, if you were just invested in that index, you would make 8.5% over a 15-year time period every year. And if you're in a 60-40 sort of balanced portfolio, you would have an average 6% return. That's because you stuck to the discipline and you stuck to the plan. So that's our mission, is to help families to thrive across generations by matching their wealth with their purpose. So we've talked a little bit about the front part, the thriving across generations and the building of wealth. I want us now to take an opportunity to welcome Ryan Asanto. Ryan is the president of National Christian Foundation in Austin, Texas. And we get the honor of working with Ryan on a number of different things and our other National Christian Foundation affiliates throughout the nation, as we want to help people to also be more generous. And so, Ryan, with that said, I'm going to turn it over to you and let you sort of take things and run with them.
Thanks, Josh. Yeah, it's good to be with you here today, and sure appreciate the time and the opportunity to talk about generosity. You know, at NCF, our mission is mobilizing resources by inspiring biblical generosity, and so we're right in line with you guys at Archetype and love working together with you. One of the things that we see is that there are tremendous benefits to being generous, not just for the causes that you support and the organizations that you might give to with your time, talent, or treasure, but the idea of being generous really does impact the person being generous directly. This is proven out by a study that came out in 2017 through the University of Zurich, and their conclusion was that being generous increases happiness, extends life expectancy, and has even been shown to have as much positive effect on blood pressure as medication and exercise. And so, you know, if you're dealing with high blood pressure, you're dealing with any kind of particular issue, you go to the doctor, what do they say, right? They say, well, watch your diet, watch your exercise. Maybe you take some meds if you need it. But being generous becomes a cure for all these things as well. And so what we love to see is people really experience a growing sense of joy and freedom in their life through being generous. And as you talk about, you know, people are always stressed about their money. Where there's a lot of money or where there's a little money, money makes us stressed. But what we find is that being free with our money, giving away our money, actually does help us find joy and peace in this life, both physically as well as emotionally and spiritually.
Yeah, Ryan, you live in that space of helping people to do that in the most efficient and effective ways, and we're going to walk through some of that in a minute. But the reason we work together so much is one of our four pillars, we call them our four quadrants, is to, actually two of them, family and legacy, is to really help families experience significance from their wealth rather than just success with their wealth. And what we want to do with that is we want to help individuals and families to really identify what is their purpose beyond just making a bunch of money. And out of having known what that purpose is, then to find their passion areas for generosity. I'm always amazed in talking to people who have generous hearts. I actually think most people have generous hearts. I think you see that in recent weeks as people are giving to all kinds of things.
For sure.
They don't have a plan for their generosity. They don't have a strategy for their giving. And so they end up just sort of giving a bunch of different places. And we want people to identify, what are those 2, 3, 4 areas you're passionate about where you can have the most impact, and then share, not only giving of your treasure, but giving of your talent as well, but share in the mission of those organizations. Like, know that you're a part of what happened beyond some small way. And then the next thing we would recommend, the last thing, is sort of, you find ways to monitor how your giving is having charitable impact. And if you're giving to 100 different organizations, that can be really difficult to do. But today we really want to talk a little bit about that effective giving, that efficient giving process. And so I'm going to let you sort of walk us through the typical way that you see estate planning done. And we're going to use an example here with $100 million. I know not everybody has that, but the principle remains the same of how it's typically done in the world.
Yeah, and I can appreciate the use of an estate of this size. We do the same thing in a lot of our illustrations, just because it makes the communication of the principles a little more clear. But yeah, in the world of estate plan, if you're looking at $100 million estate, what's typical is that a family in this situation would realize they're going to have an estate tax burden, and they would go out and they would buy an expensive insurance policy to pay the taxes upon their death, and then they would leave as much as they could to their kids, and they don't really think beyond their immediate family. Maybe they think about a little bit of extended family, but mostly they think about leaving money for their kids, and that's pretty common in America. So in this scenario, what you've illustrated obviously is the $100 million estate where in today's exemption rates, which we don't know how long they will be around, but at least in today's exemption rates, you can pass about $23 million to your kids tax free. That's about $11.5 million per person, which is the estate tax exemption can go to your kids without any tax consequences, and then the other 77 is taxable. And so if you look at the extreme tax rates that we have for estate taxes, the IRS is going to get about $31 million of that. And then the balance is going to be left again to the kids, because that's how people think. They don't really consider giving. They don't really consider other things to do with their money, the impact that they might have. What we see on our side is not that people intend to make family-centric only decisions. It's just all they ever think about, or all their advisors ever talk with them about. And what?
How often do you run into, you ask someone the question, how much do you actually want to leave your kids? And they just look at you with that blank look, like, no one's ever asked me that question.
Yeah, almost 100% of the time. When we say, what we'll ask is the question, is there an amount of money that would be harmful to leave your children? And in America, nobody thinks that way, right? Because we live in a land of more is better when it comes to finances. And unfortunately, biblically, that's not always a good idea. And so what we see is the old adage, shirt sleeves to shirt sleeves in 3 generations, is true. And so what that means is you've got one generation that basically is raised with very little access to resources. They work really hard. They build a bunch of resources, accumulate a bunch of resources in their life. They leave it to the second generation, who stewards those, manages those, spends those, and that generation raises a generation who doesn't really have a work ethic, and so they end up blowing through all the money. And so the next generation is back to shirt sleeves, right? So you have wealth that just kind of goes away without good planning and without good conversation around passing along values, not just valuables.
It's amazing to me. Our focus is that family thriving. So we actually do multi-generational conversations. We'll talk with the parent or grandparent who has the majority of the wealth, and then we'll talk with the kids and the grandkids. We have conversations at all different levels. And we're seeing increasingly when asking even the kids, how much money do you think your parents should leave you? If you have that conversation before they actually have it in their bank account, it's actually shocking how many of them don't expect or don't want or haven't thought about or would be happier, I guess, with less than we might expect them to be happy with. Once it's there, the damage is sort of done. So yeah, this is the typical way. You want to walk us through the way that the National Christian Foundation and the alternative ways of doing this?
Well, yeah, we would say, we have an estate planning, an attorney on our staff who refers to estate taxes as elective taxes, meaning you get to choose whether you pay them or not. And what he means by that is if you plan appropriately, you don't end up having to pay any estate taxes. And that plan always involves giving, right? If you plan appropriately, you can plan to give more to the causes you care about most, not by affecting your lifestyle, but by affecting how much you send to the cause you typically care about the least, or you at least want to support the least, right? So in this plan, what we would say is you can give away more than you ever thought possible without affecting what's really beneficial to leave your children, and without paying an insurance company or Uncle Sam any more than you have to. So in this plan, what you've got is a $100 million estate. You've got the maximum you can give to your kids tax-free, about $23 million, and $77 million being given away. And you want to talk about the impact you can have on the world. You want to talk about the impact you can have in nonprofits. You want to talk about the impact you can have on a church or a mission organization. You want to talk about the impact you can have on your own children by leaving them charitable giving capacity so that they have to think philanthropically. They have to think about what makes a difference in the world, and they get to give money away, right? That begins to shape character and shape work ethic and shape involvement in the world and generations in a way that just leaving them money in their own name ever could. So leaving them $77 million to give away becomes a great, great process. The only problem with this plan is, at least the way it's drawn here, is that it's planning to give after death. One of the really exciting things that we see people get involved in is they realize, hey, can I start giving money away now? If I have a significant estate, and I do want to leave some money to my children because that's a great thing to do. I don't want to disinherit them, but I also want to be giving in a significant way now. The alternative estate plan allows you to do that, not just because you're no longer writing big premium checks to an insurance company or having to plan for paying the IRS upon your death, but it's because you can start piecing off your estate, whether it's in assets or in cash now. You can start doing that today with good planning.
Yeah, I think that a lot of times when people hear the term estate plan, it sort of automatically carries the at death sort of context.
Right, right.
I don't use it all the time, but I almost sort of like the phrase legacy plan even more maybe, because it really is about starting to leave your legacy today, to leave your mark today. And so National Christian Foundation is a donor advised fund. And maybe you can explain a little bit more about what a donor advised fund is, about specifically who NCF is, but also sort of lay out how that is an instrument that can be used to start giving today.
Sure. Yeah, this is a great little slide to kind of explain the concept of a donor advised fund. And really, you can think of a donor advised fund as like a charitable bank account, or a substitute for a private foundation that's a whole lot cheaper to run and allows for actually a whole lot more anonymity for the giver, and some great benefits for giving non-cash assets. So I'll unpack all of that, but let me just walk through this slide. So if you think about a family who wants to be charitable, they can give cash straight to charities, or they can use a charitable giving vehicle, of which a donor advised fund is one kind of. And the way this works is you contribute to the donor advised fund. That might be cash, that might be publicly traded stocks, that might be privately held business interests, or real estate holdings, or mineral rights, or intellectual property, or any other income producing asset. You can contribute to the donor advised fund. You get an immediate income tax deduction based on the fair market value of that asset at the time of gift. The big tax benefit there, that big deduction. And then as cash is either in the fund because you put cash in there, or it's generated because you put an asset in there, as cash is in the fund, you get to recommend grants to your favorite ministries now, immediately, or over time, right? You can let the money stay in that giving fund. It can be held and reinvested and grow over time so that you've got more to give. Currently, there are no time restrictions on how long the money can stay in the fund. So if you said, hey, I want to put the money in a fund and I actually want my grandkids to give it away, and my grandkids are under 5 years of age today, but I want to give them some capacity to give when they become adults. Great. Put the money in the fund, let it grow over time, and like in any estate planning scenario, right, set a clause. When they hit 21 or 25 or 30 or whatever age you want, they get to start giving money away out of that donor advised fund. So it really becomes a long-term solution for multi-generational charitable giving planning, as well as a great tool for anybody who has lumpy income to start using immediately. It really helps simplify your giving and multiply your impact. It's one of the things we talk about all the time at NCF. Our goal is to say, hey, you know what? If Jesus said it's better to give than to receive, it's more blessed to give than to receive, then how can we help people experience that? How can we help people actually live that out? Because for a lot of folks, particularly people who you and I are talking with, Josh, who have significant amounts they want to give away, charitable giving gets complicated. And it can be a frustrating experience if you're concerned about who you give to and what they do with the money. And am I being a good steward by giving a certain amount of money to this organization? Well, a donor advised fund and a partner like NCF really helps you start to think through what's the right plan for my giving, and am I actually enjoying giving like Scripture says I can? Is that even possible in my life? The thing about a donor advised fund, and the thing about a partner with NCF, partnering with somebody like NCF, is that most people, including me before I came to work for this organization, don't know what's possible when it comes to giving. We just have no idea of the possibilities. You know, when we think giving, we think, okay, a nonprofit in need held a gala or sent me a flyer, and now I can write a check in support of that organization. Well, giving is such a bigger idea than that, but that's what we know, and that's what's in our frame of reference, and so that's how we typically give. We hear of a need, we respond by writing a check. But planned giving can become so much more, and it's really such an intergenerational exercise, again, to pass along values to the next generation, to save some tax dollars today, and to give more to the causes you care about most.
And just as a side note, it also makes your tax reporting a ton easier.
Yeah, the donor advised fund does for sure, right? Yeah, because if you're giving to, 20, 25, 30 organizations over the course of a calendar year, and you want credit for all of those, then you've got to chase down 20 or 25 or 30 different receipts every year when you file your taxes. Well, if you use a donor advised fund and you do all your giving through that vehicle, then you only have one tax receipt from the donor advised fund sponsor to chase down come tax time. And that simplifies your life dramatically.
Can you just real briefly, before we move on, because you and I have had this conversation the last couple of weeks, in the current environment with COVID and with quarantine and people not being able to work, and 30 million people out of work now, and everything going on, y'all have actually seen an increase in giving from funds to charities. And can you maybe share a little bit about how that has been an added benefit to using a DAF in this time?
Absolutely, absolutely. So I mentioned that there's no time horizon on how quickly you have to give dollars out of a donor advised fund. And many times when I say that, what I will hear from good-hearted, charitably inclined individuals is, if I'm going to give this money away, why stockpile it? Why store it? Why put it in a fund? Shouldn't I just give it to the charities that are in need today? I would say, if that's what you think God is calling you to, right? That's the verbiage we would use at National Christian Foundation. If that's what you think the Lord is calling you to, then absolutely you should give it away now. But what the donor advised fund allows you to do is stockpile, so to speak, charitable resources in high income years, so that when your income either goes away through retirement or is compromised because of a job loss situation or a transfer situation, then you still have charitable giving capacity in your donor advised funds, right? So what we see is people who've had significant events, maybe they had a liquidity event 3 or 4 years ago and from a business sale or something like that. Now they've got a bunch of money in their donor advised fund. And now, in a time like this COVID-19 crisis that we're in the middle of, the needs are so much more extraordinary than what we ever expected or planned for on the part of charities. People who have money stockpiled in a donor advised fund are the people who can give in times like this, right? So when there are times of extreme need and incomes are compromised, or charities expenses are way up, then people who have stored giving dollars can release those dollars now. And what we've seen throughout the month of April is that the giving through donor advised funds, just at NCF Austin, just the little pool of about 300 funds that I'm in charge of watching over, we've seen giving increase by about 50% from how giving was looking in March, right? So with this crisis hitting, with nonprofits developing needs rapidly, we're seeing donor advised funds holders really begin to release their giving capacity into people who are in dire need. And that's a beautiful, beautiful thing when you can celebrate the grant rate increasing from a donor advised fund in a challenging time.
Yeah, you get to continue to give even when life challenges. You said a challenging time. This one's societal, but it could also be familial. You know, my wife had brain surgery a year and a half ago, and that totally changed our economics within our family directly. It definitely impacted us giving out of our income. But when you have a donor advised fund, you can continue to experience the joy, the significance, the generosity of giving through it, because you've really, it's you have a financial plan to get you to your financial goals. And this is part of having a generosity plan to get you to your generosity goals. And so as you do that, there are some unique changes that can happen between how giving and taxes and really what you retain play out in different scenarios. So this can be a bit of a complicated graph. We've tried to simplify it some, but I'll let you just walk through it real quick.
Yeah. Let me walk through this. So I'll quickly say that, again, when most people think about giving, they think about writing a check to a charity. And that's kind of where their thoughts about giving stop. 80% of all charitable gifts in the U.S. are made in cash. That's great, except that cash is not how Americans typically hold their wealth. 90% of what we own is non-cash. It's non-cash assets. And only 10% of what we own is cash. And so if you think about that, 80% of all charitable giving is coming out of a tiny, tiny slice of the net worth pie of America, right? Only 10% is cash. So when you think about giving by means of just writing a check, you're not thinking about your real sources of wealth, which are typically non-cash assets. And so when people do think about their real sources of wealth, they can change the economics of their giving dramatically. And what you see in this chart is on the far left, somebody who is tithing and in the top income tax bracket, right? So if you're the whole bar is 100% of your adjusted gross income, your AGI, and then 10% in cash is going to charities. Then 33% of your AGI is going to taxes, and you're living off the other 57%. And if you're a really generous person and you said, hey, I'd like to give away half of my income, which that's a beautiful commitment and a beautiful idea, right? I'd like to give away half of my income. Well, there's the one way you can do that is by increasing the amount of cash you give away, right? So you can give away 50% of your income in cash, and that will reduce your taxes as far as you can to 19%. But that's only going to leave you 31% of your AGI as sort of take home, if you will, for your lifestyle, for any business reinvestment, for any recapitalization needs you might have. It cuts into your cash pretty dramatically. So what we see is very few people on the planet actually do this, actually give at this level, where they're given 50% of their income in cash because they need their cash. Their cash needs to be used for other purposes. When you think about non-cash assets, then you can change the dynamics of your giving pretty significantly. The IRS will allow you to deduct up to 30% of your adjusted gross income in non-cash gifts to a public charity. So if you own a business, or if you own significantly appreciated stock positions in a taxable portfolio, or if you have a real estate or mineral rights, you can give a portion of those things, right? A small piece of somebody's business generally is what would make up 30% of their AGI. So you give a small piece of your business interest or a small piece of your real estate portfolio, you get a deduction for that, such that you can double your cash giving from when you were a tither. You can reduce your tax obligation just like you were giving away 50% of your AGI in cash, and you can take home a little bit more than when you were just tithing, right? So this chart on the right really shows what we would call a really wise steward, at least per the U.S. tax laws, because you've given away as much as you can in privately held assets, which create a giving stream for charities down the road. You've doubled your cash giving in the current year. You've reduced your taxes as much as you can, and you're taking home even a little bit more than when you were just tithing. So if you follow this, what you see is that the chart on the right shows an individual giving away 5 times the value of the chart on the left while taking home more. We call that a win-win at NCF, and we love to see people get in this scenario.
We say all the time that most people don't realize that the tax code in the United States is incredibly favorable to people who want to be generous.
Absolutely favorable. Yes.
The tax code should almost motivate us to want to be generous, just from a fiscal standpoint in numbers. Can you talk real briefly, just give us 2 or 3 sentences here as I'm watching our time, but National Christian Foundation is a donor advised fund. There are numerous other donor advised funds out there. We work with many different ones. We work with y'all probably more than anyone else. We work with y'all a lot. But can you give just a brief what the difference is in the different funds and things of that nature?
Yeah, what I would say is a lot about when you choose a donor advised fund sponsor to work with, you are choosing a charitable giving partner. And what you want, just like in any partnership, whether it's a marriage partnership or whether it's a business partnership, what you want is as much alignment as possible, right? You want to be aligned from a goals perspective. You want to be aligned from a values perspective. You want to be aligned from a long-term perspective. And for people of faith in America, being aligned with a Christian donor advised fund sponsor, it can be a tremendous blessing. Not just because we're aligned on the causes that you care about most. We want to support like-minded causes, but because we take our work seriously, right? If Colossians calls us to work at whatever our hands find to do as if for the Lord and not for men, then because we are a faith-driven organization, we're going to do that with excellence. And one of the ways that's borne out at NCF is just a tremendous internal capacity to handle complex asset gifts. So when people start thinking about things other than cash, how do I give away assets other than cash? NCF has a team of about 16 gift planning attorneys in-house that can guide you in a way that no other donor advised fund sponsor in the country can. Combined, we probably have over 184 years of tax planning expertise with a view to charitable giving right under our roof. And so we don't have to go outside our organization and contract with other attorneys. When you come to work with NCF, you can work with a team of people who are like-minded, who share similar goals, and who want to see you give away more than you ever thought possible to the causes that really make a difference for eternity.
Excellent. Well, I want to hit on a couple things before we open up for questions that are relevant because of COVID and the C.A.R.E.S Act that got passed. Because the C.A.R.E.S Act actually has 3 provisions in it that again are favorable to people who want to be generous. The first one is that in a typical year, there is depending on how you structure your giving, and to be clear, we're not giving tax advice, we're making you aware of things. You would still want to talk with us or talk with your tax professional to get full details on this. But you have a 50 to 60% limit on adjusted gross income that you can give away to charity for tax deduction. That has been lifted for this year. You can give 100% away if you structure it correctly, which is a great thing. It's a great benefit. The second thing is that similar to what's imposed on individuals is that typically on corporations, and don't think just the huge corporations, a lot of businesses, small businesses are actually corporations. They have a taxable income cap of giving 10% away a year. And for 2020, that has been moved to 25%. So you can give away 2.5 times as much money through your corporation this year as you could in the past. And then the final one, those first 2 tend to apply perhaps more to people who are itemizing their deductions and a little more higher level givers. But the last one applies to everybody. If you're even taking the standard deduction when you do your taxes, this year you have a $300 above the line deduction that you can take by giving. So in addition to the standard deduction for the year 2020, there's an opportunity and an incentive to give even more. And so we just want to make sure that's brought to everyone's attention and available for them as well. Ryan, I'm so glad you're here because we're going to answer some questions now. Open it up. If you have a question, we'd love for you just to text it in. We'll take a few minutes. I've had a couple that have been sent in, and we'll try and answer them quickly, and then we'll wrap up here in just a few minutes. So one question that was asked was, at what point does it make sense to actually set up a donor advised fund?
That's a great question, and one we get a lot. And what I tell people is it's always a good time to set up a donor advised fund. At NCF, we don't have any minimums on our donor advised funds. So people who just want to use a giving vehicle because they realize it will help them focus their giving and it will simplify the process of giving, but they might be giving out of income every month and not storing up any charitable giving dollars. That person can still use a donor advised fund and with no problem, and glad for them to do so. For people who, where it really begins to make sense though is for people whose income is lumpy, meaning they might only recognize income once a year, or maybe they recognize income once a quarter, right? But they want to be faithful and consistent to their charities. So they can put their money in a donor advised fund, get the tax deduction in the year that they recognize the income, and then even out their giving over the next calendar year. So we have a lot of people who will load up a donor advised fund, if you will, in late December, and they'll give from that donor advised fund all through the preceding year, then the following year rather, and then they'll load it up again in December and do the same thing over and over again. So that becomes a real effective time to open a donor advised fund. And then certainly before any major life liquidity event, having a donor advised fund to use makes a ton of sense. So before the sale of a business or the passing down of an estate, any kind of liquidity event like that, you want to have a donor advised fund ready to go.
Yeah, and I'll add, we don't have to jump into this one right now, but if you happen to sit on the board of a nonprofit or work with a nonprofit, there are some great advantages to the nonprofit having a donor advised fund as well. And that may sound a little backwards, but if you have any questions on that, please feel free to reach out to Ryan or myself. We'll give you our contact info here in a few minutes. But as someone who has ran a nonprofit and sat on the board, there are some great advantages to those organizations as well.
Absolutely.
We have a question here on if I give 10% of my business away, but I'm not planning to sell the business anytime soon, can my donor advised fund still get funded even though I haven't sold the business? In other words, do I actually have money there to give away? How does that work?
Yeah, so if we're given 10% of a business, which NCF will hold across multiple tax years as long as the IRS allows us to, not all donor advised fund sponsors will do that, but we'll hold it across multiple tax years. And when you give 10% of a non-cash asset, there is no cash there. So that doesn't do any good, if you will, for the charities that you want to support, except that it provides you a very significant deduction. So now you personally have more cash to give. And then we're an owner in that business, 10% owner. And so as the business makes distributions to owners, that liquidity will flow to your giving fund for you to have more than to give away. So we'll participate in distributions just like any owner would. So at any point that cash is flowing to an owner, your fund would participate just like any other owner.
Okay, excellent. Another question here, and I know the story. I almost know the story you're going to want to share here, and it's a good one. But I'll let you choose. Can you share any specific stories of families? You don't have to use their names, of course, but that have really taken advantage of National Christian Foundation or donor advised fund in being more generous. And give us the 2-minute version of, I'll let you choose, but I know where you're going.
Yeah, I know there's a handful of stories here, obviously, because that's what we do, right? We help people create more giving capacity. And so the biggest one would be right before the sale of a business, right? We had somebody come to us and say, I'm gonna give away, I'm gonna sell my this actually was a warehouse. I'm gonna sell my warehouse. It's about a $10 million asset. I'm gonna give away $2 million. And we said, that's awesome. You want to double tithe? Why don't we give away the business, the warehouse, before the sale? And they had never heard of that kind of thing. But basically, by giving away the warehouse before the sale, we allowed them to increase what they had available for charity by over 50%, right? So they went from being able to give away $2 million to giving away $3.1 million without affecting what they took home from the sale. So the family took home the same when they gave away $3.1 million as when they were going to give away $2 million. But their tax bill dropped dramatically, and that's where the extra giving capacity came from, because their take home was held constant. And what we love seeing people do is really convert tax dollars into giving dollars, because that's generally more aligned with their hearts. And by giving right before a sale event, people can make that transfer and see their cash go where they want it to, as opposed to where they don't want it to.
Well, good job. You effectively went with the story that wasn't the one I was thinking of, but I'm sure the one I'm thinking of. You want to just give the 2-minute version of the company we know that's given away 99%, I believe, of their company.
Yeah. So that's a pretty extreme story, but bottom line is, and I guess this is the big point of this story, is you can give away your entire company without affecting your ability to still control and recapitalize your business. So we had a very generous man give away 99% of his company to NCF, and NCF is effectively a limited partner in that scenario. And so there's a governing board that is a charitable trust that owns the other 1% and manages the company. They make decisions about how much of the profits are we going to reinvest and how much of the profits are we going to distribute to owners every year. When they distribute profits, their fund at NCF gets 99% of those. And so this is a family and a business that gives away massive amounts of money every year because they are, while retaining the ability to incentivize good employees and keep compensation plans in check and keep development and research and development activities going in their company, while giving away dramatic amounts of money every year without impacting how much the owners want to take for themselves. And so it's a beautiful, beautiful display of generosity, and they're making a significant kingdom impact all over the world with the dollars that are produced from that company.
And this is, this is a multi-million dollar revenue company.
Yeah, it's approaching $1 billion enterprise. So the dollars given away are significant.
Yeah. So that was $1 billion enterprise, right? Was that?
That's correct. That was a B. Yes.
That's a B, not an M. Just want to make sure everybody understands that. So it's all about where you're feeling led to be generous, and there are tools out there to help you in doing that. Well, to honor everyone's time, I'm going to sort of wrap things up here. I want to make sure you know that there are some upcoming webinars. These actually are old dates here, but we're going to be repeating these in May, and so you'll be hearing information on those coming out. But really want you to know, if you want more information about any of the things that are on the left, charitable giving, investing, markets, any of that, please reach out. I don't know where Ryan's contact information went. It was there underneath mine, under my email. Ryan, you want to share with them what your email is real quick?
Yeah, you can reach out to our office. Probably best way is at austin@ncfgiving.com. And again, our website is ncfgiving.com. You can go there and find me under the Austin local office, and we'd be glad to interact. We'd love to talk about any questions you may have.
So if there's anything we can do to help you, and then I want to draw your attention to the one that just says, do you need? We put this here. We don't know where you are in your faith or your beliefs, and we certainly don't want to offend anyone. But because we truly do care about the people we get to work with, we truly do care about the world that we live in. We want you to know if there's anything we can pray for you about, or any area of your life you might need encouragement. We'd love to journey with you in that as well. And so if you want to reach out to us for any support we can give you in that area, we'd love to support you in that way as well. I want to say thanks again to Ryan for joining us and taking an hour out of his day to sit down and to walk through this. And we look forward to seeing all of us learn how to achieve the goals that we have, not only for ourselves, but also for the benefit of others, by increasing our generosity in every way that we can. Hope you guys have an incredible weekend. Make it the best that it can be. And God bless. Talk to you soon.